Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all.
Hey Patrick, nearing in on the 2 year mark, as I keep mentioning in all of these recent episodes. And I think, one of the things that usually happens when like a milestone comes up is you start reminiscing about the past. And I think, interestingly enough, we went in a completely unexpected direction. In fact, I would say first, first of its kind in Practical Nerds history. So we are going to actually, this topic is going to be inspired in a weird way as a blast from the past from AEC VC, Patrick.
So we're going to do a working session today, and this comes with an immediate word of caution and disclaimer to you listeners. If you don't like the working session part, where Shub and I are going to pull up numbers from annual reports of AEC software companies and populate a spreadsheet so that you can literally see what we're doing. If you don't like that part, you find it boring, and you think your time is better served watching glue dry, you can fast forward to the second half of Practical Nerds and just see us look at us how we interpret the numbers of Procore, Autodesk, Bentley Systems, and compare them to, what's our benchmark set again? Adobe, ServiceNow, Intuit.
And correct. And if folks are wondering what's the logic for that, high quality proven names in AEC software and also high quality SaaS companies from other industries, which are, let's say, call it proven success stories.
Exactly. And so we did that for the first time 2 years ago in 2023, where we benchmarked these companies. Look it up. It's online, fundamental.com. Look for Context SaaS Benchmarking 2023. You'll find it. And so today we're doing literally live an update of that SaaS benchmarking in that reference set of 6 companies. Again, first half is watching glue dry, but if you're nerds like us, you will enjoy the first half where we're looking up the numbers and we're populating our benchmark sheet. If watching glue dry is not for you, fast forward to the second half of this episode where we begin interpreting the data. So with that, no further ado, Shub.
Yeah.
Actually, sorry. One thing, so perhaps that everybody has seen what we're doing first. Hold up. So this should be the 2023 benchmarking. So this is what you can literally see on fundamental.com, what we did back in 2023. So we look at, for example, comparison of revenue growth, gross margin, operating income, and a few light SaaS benchmarks. Light because the annual reports don't give us all the information that we would do for our heavy SaaS benchmarking that we do on private companies. But annual revenue per FTE is an important one. Then the adjusted rule of 40, where we take the growth rate plus the operating margin, sales and marketing intensity, R&D intensity, G&A intensity, free cash flow margin, cumulative operating profit or burn of the last 4 years, cash conversion score, and the revenue multiple, as well as the operating income multiple. So this is what comes out of this benchmarking based on official numbers as of the end of the very recent fiscal year. You can find this for 23 online. Today, we're going to do the working session for 2025. Shub, with that, we're jumping now into the live watching the glue dry working session.
Let's do it. And one quick, clarification before we jump right in. We're using GAAP numbers for this analysis. The reason I have to clarify this is some of the companies in the sample set also report non-GAAP numbers for certain metrics, and those are massively different from the GAAP numbers. So I think to kind of have a benchmark, we're working with GAAP numbers here.
All right. Let's start with Autodesk. I need the revenue for 24.
The entire year of 24, right? So
that's right, fiscal year. So for context, 2 years ago, it was about 5 billion.
Yeah. So in 2025 fiscal year, they did 6.1, sorry, which is their previous year.
Calendar
that is 6 point, correct. So that was $6.1 billion.
Give me the exact number.
Okay. Hang on. Okay, bear with me here. Then I'll have to go into the press release. I was working with a different document.
I might have it here. Let me scroll to the
It's
right.
$6.131 billion.
6,131
Yes.
billion dollars. I have them here in thousands. Okay, gross profit. I also have it here. If you like me to use it, it's 5553.
Sorry, I should have planned this ahead.
No worries. So it's 5553. Then sales and marketing is exactly 2 billion. R&D 1485. And then G&A and others is 650 plus 49 million plus 15 million restructuring cost. Okay, so that gives an operating income of 1.4 billion. Now moving to cash. That is income.
The cash flow from... No, sorry, I was looking at a different one. My apologies.
So I need the cash from operations. 1607. Free cash flow, they should hopefully report that. Otherwise, we'll have to calculate it.
So what we'll have to do is the cash from operating activities, subtracting PPE, or I don't see anything specifically that could be called, unless this, purchase of intangible assets is not that. Capital expenditures, perhaps? Subtracting capital expenditures?
That is exactly right. That's what I'm looking for.
So that would be 1,567 million.
Okay, so this is this minus 1,567 million. So that would be a free cash flow of 40 million. Does that sound right?
Oh, sorry. I reported the 1,567 was the free cash flow.
Okay, I got you. So the 40 million was the CapEx.
Correct.
That sounds more correct. Yeah. All right. Yeah. Then back to the balance sheet. Equity. Here we go. 2,621.
Yep.
The total debt. So the liabilities. Or in other words, the total balance sheet minus the equity.
So that would be 8.212.
All right.
Billion.
The cash 1,599.
Yes.
And working.
I mean, should we all marketable securities? You wouldn't include in cash, right? So it's strictly cash and cash equivalents only.
We can include the marketable securities as long as we do it for everyone. That's fine.
Let's keep it simple. Let's just go with cash and cash equivalents.
Let's go with cash.
Yeah.
Okay. And then working capital. So we have here 1,008 receivables. Payables is 242. I don't think they have any inventory. So working capital 766. Employees. I got
1,000. No, that's not the right number.
Yeah, so I have one from January 24. Okay, 15,300 is the number. And then market cap, can you see that per
as of today?
Yep.
Yeah. 61.45 billion.
Oh, it came up. 61.45 billion. All right, that was Autodesk. Fantastic.
And the growth that we're reporting. So the growth that we're reporting is the actual growth over the last 2 years. Is that what we're doing?
Exactly. It's the CAGR over the last 2 years.
Okay, gotcha. So we're not taking into consideration their guidance for the outlook on growth?
No.
As of now,
no.
Okay.
We're doing completely trailing.
Okay.
All right. That's Autodesk. Let's go to Bentley. Do you have it open?
Yes, but not but not exactly what we are looking for. Hang on.
All right. By the way,
This
Bentley
is
has a fantastic annual report, very granular split of revenues by product lines, etc. All right, I got the P&L here. So revenue is
1353.1.
5. Gross profit 1095,328.
Looking for it. 1095328. Yes.
Yep, great. Sales and marketing 255,177.
255177.
Okay, and then G&A and others is 210,374 plus 12,382 plus 33,998.
Yes.
All right, gives an operating income of 302. All right, moving to cash flows, cash from operations.
Yeah, so that is 435.292.
5,292. Okay, free cash.
And free cash. So subtracting, so the capex is 14.046. So I guess that would mean the free cash flow would be 421.246.
You have very good head math skills. Okay, and now to the balance sheet. I need the equity.
Yes. So the equity is, yeah. So it's one. So the unit is millions, right? That we're working with?
Thousands I have here.
Okay. So then it's 1041120.
Okay, debt, total liabilities.
2358687.
2358687. Okay. Cash.
64009.
64009. And the working capital. Really, that's all the cash. Interesting. 64 million only. Okay.
They have a tremendous amount of accounts receivable.
Oh yeah,
322862. What's the payables like? The payables is not much, so I think that's the answer.
All right.
A lot of the cash, it's a pretty significant working capital position here.
16479. No inventory.
So that would be
this kind of business.
So that would be 306. Should be 306383, right?
All right,
As working
got it,
capital. Nice.
And the number of employees that I have here. See, it's always a bit tricky.
Okay. Yeah, that's not there in this one.
So here I asked Dr. Google. It says approximately 5,000. Let's see if we can get. So it says 5,500 on macro axis. Yeah, probably not perfectly correct, but I think that's fine. Let's go with 5,500. Okay, and the market cap per today, Shub?
$14.1 billion.
14.1 billion. All right, then moving on to, let's skip Adobe. We'll do that now. We'll do that later. Let's go to Procore.
Okay. The big one. So, hang on. One sec. I thought I had it ready.
Yeah, you have to go very far back in the annual report to find the financial statements. Make of that what you want.
Yeah, so that's
I
why
got it here.
Okay.
So revenue is 1151708. Gross profit 946096. Sales and marketing 552019. That's a lot. R&D 312987. And G&A and others 217513. Negative operating income. Cash from operations 196 172. And then the free cash flow. Do you see the CapEx?
I must admit, I'm still sort of finding my way through the information.
Okay, it's page 161, but I got it. This one minus 19143 minus 49.
Okay, we're now looking at the cash flows, right?
Yeah, exactly. Free cash flow. I have 127 for free cash flow. Is that what you have?
So 177?
I have 127. 127 because I have the
Oh,
capitalization
the
of
capitalized
software dev.
software development. Okay, yeah.
Yeah. Okay,
That
so
makes
you
sense.
came to
Yeah.
the same. All right.
Yeah.
And now I need the balance sheet. Where do they have that buried? Here we go. Equity.
Equity is 1288353.
I got you. And liabilities is 813018. Boy, that is an interesting equity.
Isn't it
to debt ratio.
815941?
15941. No, I'm looking at the total liabilities line. Total liabilities 813018.
So I'm looking at the end of year earnings release, which also gives the financials.
Okay.
I mean, look, I think on the
2
margin
million
it doesn't
difference.
change. Yeah.
Yeah. All right. So cash is, so it's very cash rich, 437,722.
722. Yes.
Plus they have another 340 million in marketable securities, which we didn't put for the other companies.
Yeah.
And then working cap, Shub, help me here.
That would be, so that would be 210,403.
210,403.
Yeah.
All right. And then number of employees. 4,203.
Okay.
And the market cap per today?
Almost exactly 10 billion.
10 billion. All right. So these were our AEC comps. Shub, I got a CAGR on the revenue for Procore of 26%. For Autodesk, 11%. I think you said Autodesk grew quicker. Do we have a mistake?
No, there's a reason for that. Remember the question I asked you, are we looking at CAGR or are we looking at guidance as well?
Aha. Okay. Gotcha.
Yeah. So there's like so I think if you especially, so keep in mind, this is all the earnings or the financials until the end of calendar year 2024. Things start to melt away a little bit this year, and especially if you look at the guidance.
I hear you.
Yeah.
Okay. So let's then continue with Adobe.
Okay.
Do you have the numbers?
Give me a second and I will.
I'm proceeding on a few other items in the meantime.
Yes, I have it.
All right.
So revenue. So keep in mind, Adobe's fiscal calendar is slightly different. So it ended instead of December, it ended in February. So with that in mind, the revenue for the year was 5.714 billion.
Are you sure? Because it used to be 17 billion 2 years ago.
You're right. I'm sorry. I looked at the 3-month information. So it, my bad. Just bear with me again. Sorry, 1 second.
No worries.
Yeah. Okay, now I have the correct one. It was 21.505.
21,505. Gross
The
profit?
19,147.
Wow.
Yeah.
Sales and marketing?
5,764.
R&D?
3,944.
And G&A and others?
2,698.
2,698. So that gives an operating income of 6.4 billion. Cash from operations?
2,921. Sorry. That's not the right one. Hold on. Sorry. Just bear with me. Okay, so for some reason in the cash flow statement, it switches over to a quarterly view. Just bear with me here. 1 second. Sorry for the wait. I've just
No
have to
worries.
switch to a different document, and that's
I'll proceed with Intuit in the meantime. So we all get really dizzy here.
yes.
By the way, if any of our listeners are wondering why we don't ask the AI to do this for us, the answer is we think you master data when you actually work with it.
Yeah, I agree. So operating cash flow for Adobe, by the way, was 8.06 billion. If you want the exact number, I'm still digging through. For some reason, it's a
Sorry,
bit
that was
hard to
free
get.
cash flow or cash from operations?
That was operating cash flow from operations.
8063.
Yeah, and the free cash flow, I think, is going to be a bit harder to get. 1 second.
If you want to make your life easy, you might find it just on Yahoo Finance.
Yeah, I'm just resorting to something like that. So it was approximately 7.9 billion for Adobe.
7.9. All right, then moving on to the balance sheet, equity.
Yeah, so 14,105.
Debt, liabilities.
16,125.
And cash.
7,613.
Okay, and working capital. Hold on, Shub. I think actually in the previous ones, we forgot in the working capital the cash position. We only did receivables minus payables. But that is easily fixed.
Sorry, what do you mean? We reported cash separately and working capital separately.
Yeah, but in the working capital, I didn't include the cash. I only did receivables minus payables, but that is easy. I just add the cash Here we go. That's that. Yeah, because we need to take the current assets.
Oh, so is there a different definition you're working with? Because working capital by itself alone would just be payables, receivables minus payables plus inventory.
No, it's current assets minus payables.
I think, okay.
Go.
Are you sure about that?
Yep, I'm very sure about that. Because that
Okay.
is the capital that lies around that you are not putting basically that you have lying around that needs to work for you. Yeah, we're still taking a shortcut here because we're not including the marketable securities in this one. So just because we're a little bit lazy today, etc. But yes, but I just fixed it, so we have it included, and now we need to go to Adobe's working capital. So just give me receivables and payables.
The net of it, right? Receivables minus payables.
You can also give me the net of it. That's also fine.
Okay, so the net of it would be 1711.
All right. Okay, that's a very big working capital position because they have a huge amount of cash war chest. All right, that was Adobe. I already started with ServiceNow. Do you want ServiceNow or Intuit?
Whatever. I think for just give me a second. I'll pull up the appropriate. Which one do you want to go with?
Let's finish Intuit. I did it in the meantime here. So GNA
Okay.
and others. I think I got it here. That is 5706. Oh yeah, so just barely. No, that is. There must be a doubling here. Hold on. Oh yeah, here we go. Here we go. Sorry, I'm now doing it. Off of Yahoo Finance.
You know what would be epic is after all this population of data through which our very kind and patient audience has been bearing through all of this, then we wrap up the whole analysis in just a handful of minutes. And there you go.
Yeah. Yes. Okay. Then cash from operations. 4884. Free cash flow. Here we go. That is 4634. And now looking at the equity. 17269. Liabilities 10511. Cash, current assets, cash. Oh wow, they have a lot of cash. Oh, hold on, that is cash equivalents. I just need to wait. Here I might be mixing in the marketable securities. I'm a little bit lazy now. Working capital is this. Employees 18,200, market cap 182 billion as per today. And for Intuit, I need the revenue from 2 years prior.
From 22, you mean?
Yes, I got it here. All right, here 12,726, and the operating income was 2,559. Okay, 13% CAGR growth. All right, that leaves us only with ServiceNow, sir.
Yeah.
Let's start with the recent fiscal year revenue.
So the revenue was 10.984 billion.
10,984. What? That is crazy. Do you know what the market cap of ServiceNow is?
Let me check.
I can tell you, 202 billion.
Yeah.
Wow.
I was about to guess something in the 200 billion ballpark. It is 202 billion. Yes.
That is a crazy multiple. All right, but we'll get to that.
Yeah.
Gross profit.
8697.
8697. Okay, sales and marketing.
But by the way, while you're at it, the free cash flow is 3455. Because that's how we roll around here.
Nice.
Net cash provided by operations 4267.
Yeah, okay.
Okay, so for some reason, sales and marketing R&D is not over here in the release.
I might have it here. Yeah, I got it. So that is 3854. Let me see. R&D. Here, 2543. And then G&A is 936. Yeah, that is right. All right, and then off to the balance sheet, equity. I have it here.
Sorry, for some reason I don't have it. Yeah.
7628. Liabilities 9759. And the cash here 1897. That is the pure cash. Working capital, I think I have it here. 412. Oh, that is remarkable. Oh crap, I actually looked at the wrong column. Sorry. Actually, working capital is this. The cash is this. The debt is here. This, and the equity is this. Yes. I hope I did the... Yeah, that's right. Okay, Shub, we just filled the numbers.
Nice.
For 24. Now I just need to add the revenue for 2022 for ServiceNow. That was 7245. And the operating income was 355. Oh, wow. Okay. Shub, we made it. All right. Nice. Dear listeners, this was the first half of the watching glue dry portion of Practical Nerds. Let's move to the interpretation. You and I have not seen these results. Before I go to the 2025 results, should we review 2023 from 2 years ago?
You mean the one you had prepared earlier? Let's do it.
Exactly.
Yeah.
All right. So here you see the numbers from back then. I also have, like, for the lazy, this sheet here. Let me exclude the reference group in this one, just because let's focus on the AEC one. So back then, Shub, we had Procore as the clear leader in revenue growth, CAGR, 36% over the reference time frame. Autodesk, Bentley, both of them at 15, 14%. 15, 14% for companies of those market caps is still very good, no?
It is especially good, as I've been hinting, when you see the latest Procore earnings and what they're guiding for the rest of the year.
Okay.
Yeah.
Autodesk has always shown on gross margin. So it was 90% back then. I actually did it with Dustin from Edify the other day live on Bricks, Bucks, and Bytes, and we both looked it up, and it was 91% in the latest, which we'll see in a minute, but it used to be 90 even 2 years ago. Bentley, Procore were behind that far, actually, 78, 79%.
Mm-hmm.
Operating income margin, Bentley, however, and if you remember, Shub, so last year there was an activist investor going after Autodesk, Starboard.
Yes. Mm-hmm.
And Starboard had criticized that Autodesk doesn't make enough of its high gross margin. You saw it in my benchmarking, actually a year earlier, because Autodesk and Bentley have near equivalent operating income margin at 20 and 19% respectively, which means that Bentley is much more efficient with R&D and sales than Autodesk.
Yes.
But Autodesk knows how to use its scale, its leverage. It has 365,000, back then it had 365,000 annual revenue. That's not ARR, annual revenue per FTE. Bentley at 220,000. That is for a SaaS company at that scale, not very good. 220.
Yeah.
So we get to the adjusted rule of 40. Shub, what is the rule of 40?
So you add the revenue growth to some margin number. Now, the purists will say it should be the net income margin, but there's various interpretations. Some folks will add the EBITDA margin, some people will add the operating margin, etc. If you get a summation of that to be more than 40, the wisdom, or call it the VC wisdom, is, or growth investor mindset, is that you have a business which is likely to compound.
Exactly.
Yeah.
Exactly. It's a measure of, another way how you can think of it is if you actually acquire and retain efficiently and convert that into margin. And so Autodesk, Bentley, both in around 33, 35, so not quite making the 40, but 40, to be fair, the rule of 40 is also something that applies to growth companies a little bit better.
Yeah.
But Procore, man, they were actually negative territory back then, minus 5%.
Yeah. I mean, by the way, to give you an example of how, just a small tangent of how this number, even though it may seem like it's obviously tilted in favor of growth companies, there's companies like Visa and MasterCard which utterly obliterate this metric.
Oh yeah, do you know by heart what they are?
I think it's somewhere in the 60s. Because Visa has like an operating income margin higher than 60%, and it's still growing around 9-10%, by the way, in revenues. So high 60s, maybe in the 70s.
Yeah, that is the power of infrastructure plays.
Yeah.
So that's where you want to play. Minus 5%, that was not good back then.
Yeah.
So coming actually or further down on the efficiency, what is driving these margins that we just looked at? So back then, the sales and marketing intensity, or another way to put that is how many dollars in sales and marketing do you have to spend to acquire and or retain $1 of revenue? So Autodesk about 35 cents on each dollar of acquired or retained revenue. Bentley about 18 cents. Very, very efficient. Procore 59 cents back then. So very sales and marketing heavy enterprise in 2022, but I analyzed 2023 was 22 now. R&D intensity, Autodesk, Bentley head to head, 24%, 23%. So this is the R&D spend divided by the revenue. Procore 38%. G&A intensity. So this is where Autodesk would have had a case against Starboard. So Autodesk G&A intensity has been 11%, Bentley's 18%, Procore's 23%. But because Bentley is so much better in sales and marketing, and Autodesk was not, that's where Bentley basically caught up with Autodesk on the final operating margin. All right, then free cash flow margin, right? So this is basically dividing the free cash flow by your revenue. It tells you, hey, how effectively are you converting your revenue into actual free cash flow? Autodesk has a very good number here back then, 40%, Bentley 23%, Procore minus 5%. So actually back then it lost money, right?
Yeah.
And so it costed cash flow. So this is a measure of cash generation. Another measure of cash generation is how much operating profit or burn you had the last 4 years. So Autodesk compounded over the previous 4 years on 2.6 billion. Bentley generated 620 million. Procore burned 720 million. Publicly listed company at that time, how old? 18 years?
Yeah, I want to say it started in the early 2000s. Let me quickly check.
2004, I think.
2002, actually.
2002. Okay, so then it was actually 20 years old when I last did this analysis. So then in the previous 4 years, it had burned 720 million. If you ask me, for a 20 years old company, that is something to look at. All right, then the cash conversion score for Autodesk, actually very good back then. Almost 300%. Bentley, 47%, not very good. For Procore, 116. And then the multiple on the market caps, either the trailing annual revenue or the trailing operating income. Autodesk, you can argue whether it's under or overvalued, but 8.7 times on the trailing revenue. It's not a multiple where people would say, oh my God, that is overly expensive. Just by pure benchmarking, and you see it, Bentley 14x, Procore 13x back then.
Yeah.
And then if you apply the same basically on your EBITDA multiple, so Autodesk was a 44x, while the others were 72, and on Procore you couldn't calculate because it was negative.
Yeah.
So here the picture was, well, Procore exactly only on growth outperformed the others, and on every single other metric, without exception, only the cash conversion score, it was worse than all the other the other two comps.
Yes.
And in every regard, it was behind Autodesk back then, with regards to these kinds of multiples and
Isn't that
benchmarks.
something? Yeah.
Yeah, and we're not cherry picking, by the way. We're literally using the GAAP numbers that are being provided so that we can actually make a comparable set. I'm sure if you have internal numbers, you can also kind of cherry pick other metrics to come up with something that looks different. So now we're jumping back to 2025, the exercise that we just did. Let's now project into the latest year. Should we use the charts first? I think so, right? So this is a big reveal now.
Yeah, let's do it.
All right. So we're going for the revenue growth. Hold on. Why is this still saying Adobe, Salesforce, Dropbox? Let me just briefly see, Shub. I need to do some adjustments here. Sorry, I literally did not prepare this. Why is this? Benchmarked Q13. Aha, here we go. All right. So this should be Adobe.
Is it just a case of replacing the Dropbox name with Intuit?
Yeah, it should be. I hope. All right, so this works. Here. Hopefully. Aha. Yes, hopefully that is the case. All right. Let me just double check. So ServiceNow revenue growth 23%.
Yeah, that sounds right.
Sounds right. Okay. And Intuit 13, gross margin 79, operating income 24. Let's see, 13, 79, 24. All right, so now we have it. Let's go back to the charts. So revenue growth. Shub, we see Autodesk 11%, Bentley 11%, head-to-head. Procore still ahead, 26. It used to be 36.
Correct.
2 years ago. So slowed down. Adobe also 11%. Intuit 13%. So you're kind of getting the impression here, at that scale, you're in really good company if you can maintain like 11, 12, 13% of annual growth. ServiceNow outperforms 23%.
Here's a spoiler about what I've been hinting at for a while now. In their latest, most recent earnings, they're actually guiding for 8% annual growth in revenue.
Procore or ServiceNow?
Procore.
Oh.
Yeah, so which is why it's sort of now on a, and we'll probably not go there, but they're also guiding for gross margins to reduce further. So you're seeing this combination of factors, but leaving that aside, you can see the growth sort of melting away rapidly.
Interesting. It sort of fits with what folks in construction tech who are connected will hear behind the scenes. This is not financial advice. This is not saying that is true. This is pure rumors, people who have told me. I can't confirm this, and I'm not saying it's true. But some people told me that Autodesk is stealing customers from Procore. Yes.
I mean, look, for the rest of for calendar year 2025, if you look at what Autodesk is guiding in terms of revenue growth and what Procore is guiding in terms of revenue growth, Autodesk actually projects faster growth, believe it or not.
Interesting.
As a percentage. Yeah.
All right. Well, we'll have to monitor that. Let's move to the gross margin. So Autodesk improved to 91 from 90. Bentley also improved to 81 from 78. Nice. Procore improved from 79 to 82. And with that, they are in very good company and even ahead of companies like ServiceNow and Intuit. ServiceNow has a little bit of a consulting component to it. So that might be an explanation of why the gross margin here is at 79. But still, for a SaaS company, that's where you want to sit. Intuit 79, Adobe 89. Together with, I mean, Autodesk is best in class here.
Yes.
But by the way, here just a cautious reminder again to founders and companies in general. We often get pitched by founders building SaaS or various versions of software who pitch a steady state software margin of like in the 50s and 60s or lower. Keep in mind, it's hard for us to believe that to be a satisfactory thesis. And if you wonder why we say that, and we have said this to founders in the past, please remember this graphical representation.
Yeah. Yeah, I will accept lower gross margins if it comes with extremely efficient marketing and sales thesis, and a reason why the S&M intensity would be very, very low, because then that would be a business I will judge on contribution margin after marketing and sales. But you can't have both, right? So you can't say, hey, I'm going to have SaaS like sales and marketing cost, and yet the gross margin is only 50 to 60%. That's when your business will basically crumble.
Yeah.
Which brings us to the operating income margin. What's the odd man out here, Shub?
Yeah, I mean, check that out. I mean, now look, the bull case here is I think they went from something like -40 or something that we had 2 years ago to -12. But again, I think the argument, as you rightly said, we're talking about a company which at this point is 22 or was 22 years old. I mean, is that how competitive or close to best in class is it to have that sort of a margin structure?
Yeah. So you're right. It did achieve better margins, Procore, and I think that's something that shareholders will be happy with directionally. So it used to be -40% 2 years ago. Now it's -12. Autodesk, Bentley just slightly. Well, Bentley actually improved from 19 to 22. I think that's actually very commendable. Autodesk 20 to 22. Adobe actually reduced. So it used to be 35. It's now 31. Yeah. And then ServiceNow 12%. That is not that great, I would say. I know you're a big ServiceNow fan as I am. I think Bill McDermott is running a fantastic company. That is the ex-SAP CEO, by the way. But the 12% did surprise me, I have to say.
I wonder if, when we look at these companies, other than Procore, I think the only other company which can maybe have legitimate claims to being a growth company at this point is perhaps ServiceNow, or the closest to be a growth company. I think many of these companies are fabulous. Even a company like Intuit still growing the way it is, it's very commendable. Perhaps it's like a growth premium reinvesting back. I don't know. It's an explanation. I don't know if that is indeed what is happening.
We'll find out in the next charts here if your thesis is correct. So keep that in mind. Let's go to the annual revenue per employee. Let's look at the right side of the chart, what best in class looks like. So Intuit, 900,000 revenue per FTE. Wow. Is that a scalable organization or what?
Yeah, I mean, when I think of it, that makes me wonder, are you thinking about this thesis, Patrick, which I think I remember seeing, wondering, I don't know what inspired me, that or maybe it was also a discussion we had. Actually, you know what? It was a discussion we had internally. I don't want to mention which company. It was in the context of one opportunity we were discussing. And the discussion veered towards the concept of, hey, don't build software, build a platform ecosystem. Maybe I'm just paraphrasing here. I think the terms used were slightly different. And when I think about it, I think of all these companies. I think Autodesk has claims to being an ecosystem, but Intuit perhaps is the closest to being an ecosystem. I wonder if the others truly represent an ecosystem.
So I think there's that. But actually, when I look at the set of companies here, Adobe is at 700,000, Intuit is at 900. I think you see here much more product-led sales in Adobe and Intuit. I think these are products that in and of themselves, users understand. They are enterprise contracts in these two companies, but they are also a fairly decent proportion of, hey, I do TV ads or I do other forms of media targeted towards users rather than enterprise buyers. And there's, when it comes to the enterprise contract, oftentimes a bottom-up motion within Adobe and Intuit that will not necessarily be the same case with the other four companies here in the same way. And that's something I love, the power of community. So you know how much I'm a fan of that. So grassroots up motion flanked by top-down enterprise targeting, you can then have very efficient organizations. And the second thing is, I mean, both Adobe and Intuit are incredibly sticky products.
Yeah.
The Autodesk suite as well, also very sticky. But I would say you can judge by these numbers that the stickiness and the retention from Intuit and Adobe might be in a league of its own.
Yeah. I think the stickiness is also a function. I don't know if you've covered this in any previous episode in Practical Nerds, but at least in internal discussions, we quite often talk about workflow integrations and distribution, what software should actually solve for. And I think in some of these solutions, the way it solves very well is the workflow is very tightly integrated. When you have become a Intuit customer, you're not just saying, hey, you know what? I'll just take QuickBooks and I'll be done with it. You're also eventually thinking of getting TurboTax, maybe you're thinking Credit Karma, and I think there are many other things going on, all working in conjunction with each other. And the more products you take from them, the more useful it becomes for you.
100%.
Yeah.
100% I subscribe. And then let it not be unmentioned. So Adobe and Intuit, I would count them as innovative companies. But I would expect to see in the following charts, we'll test this, apart from the marketing and sales function being simpler for these two companies due to what we just discussed, I would not be surprised to see in the following charts that the R&D intensity is actually lower, because from a product perspective, developing Autodesk Construction Cloud, Revit, the Bentley suite, Procore's products, you will constantly have to engineer these and ServiceNow too, these very complex bathtubs, as we use as a metaphor here.
Yes.
Whereas Intuit and Adobe, I think you can get away with very incremental improvements on a simpler product.
So Intuit, I would agree with you. Again, without knowing more, I'm just imagining if Adobe, at least theoretically, might have to contend with more product development to put up a face against the likes of Canva, Figma, and the others.
Maybe. I mean, we haven't done that exercise today, and I'm a little bit time-stripped to do it, but next time I want to know what is the revenue share of the Acrobat format that feeds into Adobe's revenue.
Good question.
I don't know.
Why don't we go through this? I'll see if I can quickly pull it up.
All right.
Yeah.
So now we look at the rule of 40. Actually, this is interesting. You see practically all of them hover between 33 and 42, except Procore.
Wow. Yes.
Yeah.
Yes.
So it's sort of, you see that this rule is really working, and it allows you to spot the outlier. So
the interesting thing is, before we started this exercise, I would have guessed that the one company which would breach the rule of 40 or satisfy it would be ServiceNow. But I'm proven wrong. I wasn't expecting Adobe to be the only one.
That?
For some reason, I imagined that it would be a faster growing company, but have comparable margins. But clearly, the margins are pulled down way more than they should have been.
Yeah, they had the 12% operating margin, if you remember this one. Yeah.
I mean, it's interesting. I think maybe, I think Adobe is perhaps doesn't get as much credit as it should as like a high quality company.
I mean, it's pretty fantastic ecosystem, proven by the numbers. I think Autodesk Bentley being at 33 is also commendable. It just shows that there is a clear at scale balance between growth and margin that can be maintained, and that there is a band within which you can truly operate. And if you're outside of that band after 22 years at that scale, you really are not performing to the norm that shareholders should expect. And that unfortunately can be said about one company here.
Yeah.
So now we'll get to the root causes. Sales and marketing intensity. Shub. So here we see Procore at 48 cents. It used to be 59. So kudos to the management team for trimming down a little bit. So now it's 48, but still clear outlier. I mean, look at Bentley. 19 cents. Bentley is the standard for infrastructure related software. And you can, I imagine that's one of the reasons why the sales and marketing here can be much more efficient, because you're a default in a large enough market.
You are right about Adobe and Intuit not having to be very sales and marketing intense.
Right? Yeah. ServiceNow 35, Autodesk 33 cents on the dollar. Autodesk used to be, let me tell you, 2 years ago, 35. Yeah, so it came down. Adobe was 28, so now 27. So pretty stable.
Okay.
Interesting. Now let's go to
Yeah.
R&D intensity. Adobe and Intuit, the lowest here. They spent the least R&D dollars on the revenue.
Isn't that interesting?
Yeah,
Okay.
Procore the highest, 27%. Let me just tell you what it used to be. So Procore was 38. So again, kudos to the management team for trimming here. Autodesk remained at 24. Bentley reduced from 23 to 21. Adobe 17 to 18. So same ballpark. Yeah, it's interesting how Adobe Intuit, strong product suites, strong communities, strong defaults, high stickiness, product-led growth, product-led sales, depending on how you want to look at it. All of that contributes to low intensities.
You know, so it's interesting. You know, another academic way of looking at it is maybe it's not a case of them spending less on R&D. It's just that through the community and workflow ecosystem approach, you just get synergies and layering of revenue, and that's why as a proportion, it sort of reduces. Maybe, I don't know. Yeah.
Yep. Which we should also see in the G&A, so general administrative intensity. Autodesk 12%. I think that's what we also had 2 years ago. Let me just confirm. 11%. Yeah, so this is not where Starboard's critique, I think, should have been directed, is the 12%. I think if Starboard, when they published their numbers last year, I imagine now, hey, this was about the sales and marketing and R&D intensity. The G&A intensity is good. ServiceNow 9%. Adobe, Intuit, lots of foosball tables here, but actually, and fruit baskets, 13 and 12%. Bentley, 19%, Procore, 19%. So clearly here, not best in class, but Bentley should be given a break because their R&D intensity and their sales and marketing intensity is so efficient. So
indeed,
maybe they deserve that little bit nicer headquarter. So that's that. Let's look at the free cash flow margin. So, okay. So Autodesk.
One thing to call out here. Technically, it is free cash flow, what Procore is reporting, but it is free cash flow because it's inflated with stock-based compensation, which is also a factor in the other companies here, but it affects Procore much more directly. That's why it swings from a loss on a P&L basis to a free cash flow positive.
Interesting.
Yeah.
It's a good call out. So now here it has actually a positive free cash flow margin of 11%, but still, 2.5-3 times behind its peer set here. So Bentley is best in class in the AEC software set that we have here, 31%. Autodesk behind, 26%. And then between the more generic SaaS companies here, we're oscillating between 28 to 37 with Adobe. Yeah, so Procore is just
that's actually remarkable. Bentley going from a 79 gross margin to a 31% free cash flow margin. That is very efficient.
Pretty good, no?
Yeah.
It used to be 23 2 years ago for Bentley. And actually, Autodesk dropped hard from 40% 2 years ago to 26%.
Oh, wow. Okay, yeah. You're right.
Yeah. Okay, so the cumulative operating profit. So I think this is only last 2 years. Let me just briefly confirm. Yeah, exactly. So here, actually, sorry, we can't use that number because I was lazy and didn't add 2023. So let me delete this one. And then the cash conversion score.
Wow.
So Adobe, almost 100%. That is crazy. So here the formula is revenue divided by equity plus debt minus cash. So that's your cash conversion score. That's pretty remarkable. Actually, Procore here is second in line, 69%. I wonder if it has to do something with their financing and investing activities and how that affected the balance sheet. We would have to dig a little bit deeper. I have a feeling here that this has to do with some cash flow and security effects. Bentley 41 and the others oscillate around the 65.
Yeah.
Adobe. I mean, that's so. Now let's look at valuations. Shub. So ServiceNow, everything that you have seen here. So it's valued with 18.5 times the trailing revenue. Everything that we've just analyzed, do you feel like that's the outlier here? I mean, compared to Adobe, 7.6.
Yeah, okay, having gone through that, I would not say it merits that much of a disparity. Definitely not. In
Warren
fact,
Buffett would buy Adobe.
yeah. I would say, of all the companies we've looked at, Bentley's impressed me also, I have to say. Bentley,
Yeah.
Adobe, Intuit, very impressive companies.
I have to agree. And Bentley got a new leadership 2 years ago. So
Okay.
basically right after we did the last benchmarking. They seem to have an interesting strategy from the outside in. I have not asked them directly. So I'm interpreting outside in. I have no proprietary information that I'm using. It looks to me like they're going a little bit more after an ecosystem play and even an open source inspired play in some corners. So they are valued at 10.4x, Autodesk at 10x, Intuit 11, but Adobe, man, it's actually, I expected Adobe to be where ServiceNow is in terms of valuation, given the numbers that we just looked at.
Yeah, it does look like an anomaly when you present it graphically like that.
Yeah. I guess to be expected that Procore is valued lower than Autodesk or Bentley is, looking at these numbers. So that's perhaps not a surprise. And then doing the same basically on the EBITDA multiple. So here ServiceNow looks even more as an outlier, 150x EBITDA, Adobe 24, Intuit 47, and Autodesk Bentley also in the 47. So the clear outliers here are ServiceNow and Adobe, and then for Procore it doesn't make sense because it's negative.
Yeah. Interesting. Isn't that interesting?
It is, right? So here we have the overview. We'll publish this, I guess, next week, Shub. Now that we have done this episode, we have the numbers. We'll just make an update to the article from 2 years ago, and everybody can have these numbers.
Yeah.
And play around with them, see what we did. The formulas are available to everyone. Also now documented how we entered the data. So I hope, I hope this was interesting for the nerds among you all. And we'll make a write-up too, so that you can just digest it in a written format too. Shub, thanks for the time.
Actually,
took a little bit longer.
Before we go, I also want to make a note here. Sometimes when we have discussions with founders, right? So in businesses, which are business models which are very familiar or very well known, but also in some cases where business models which we actually have privileged information on how such companies are to be valued. And quite often, founders come to us with expectations that are clearly very different from what we are familiar with. And even when we provide expectations, I think they try to rationalize it and so on. I think this hopefully is an exercise to also show you that there's a reason we still try to stay grounded on what we understand and what we have actually seen, even with examples from our portfolio. Because even if you are on a different, let's say, valuation multiple or valuation framework today, whether you like it or not, the truth will eventually catch up. And that time it'll really hurt.
Okay, Shub, now we need to stay on another 5 minutes.
Okay.
But I want to build on this. And it goes back to something you and I discussed, I want to say maybe 2 weeks ago. Perhaps you remember this. I told you that another GP that I follow, I don't know him personally, but I've respected his thinking, at a growth stage firm, put out a comparison of the TVPI, the total value to paid in capital, and the DPI.
Yeah.
So let me just briefly remind you what he said, right? So this person, I found it fascinating how he had looked at it, and it immediately clicked with me. So this person was basically arguing, you can see the proof that public markets are more efficiently pricing SaaS and tech companies than private investors like VC, and especially early stage VC, also including growth VC. You can see the proof that the public markets are properly valuing the assets and the private markets are not, in how the performance of the VC funds actually develops towards the exit of their companies into the public market. That was the thesis. And then he brought the proof. It was logical proof, I should say. But you and I, we know, by numbers, this will be true. So he said the following. He said, okay, so if the private markets were undervaluing assets compared to the public markets, what should happen is that the TVPI, the total value to paid-in capital, which is the value of a fund in fair value divided by how much was invested. When that TVPI were to grow towards the exit, let me rephrase it. When the TVPI towards the exit would stay the same, and the DPI, the distributions to paid-in capital, so basically this is the realized fair value to your investment, would catch up to the TVPI. If that were to happen, that means you're efficiently marking your assets in the private market. However, if the TVPI actually comes down to the DPI and the DPI doesn't catch up with the TVPI, it means that you completely overvalued your assets in the private market and the public market has just valued it efficiently. You know what VC is? It's the latter, not the former, right?
Yeah.
Which means that when you now deal with an investor and that investor tells you, hey, I don't want to pay your multiple, there is no reason to be insulted or to feel slighted or to feel like that's a cheap investor. That's an investor that knows this effect. We call it multiple compression.
Yeah.
And that effect is something that you have to factor into your deal-making abilities. And actually, the later you go, the more you will actually have disciplined investors that think about that portion of their business model, where they price it closer to how the IPO markets will be. And the early stage investors won't. Now, typically founders will, not typically, but oftentimes founders will be taught, but it doesn't matter. Just take the maximum multiple so that you get the more money for the dilution. You don't really change the dilution because it is what it is in many cases. Exceptions exist, but you can get a little bit more money. I think that's a fallacy in most of the cases because it actually means that you're setting your company up for expectations at the next round that are that are harder to catch up to. And on the other side, if you actually value your company properly throughout the journey, you will always meet more money. That's what I'm always, telling my founders.
No, you're right. And the downside of the other situation where you're just optimizing for the highest valuation today, you may find yourself that you're either at the same valuation 3 years or 5 years later, and that actually happens. We have plenty of examples of that. Or with every round, your valuation decreases over the next 3 to 5 years, which also, by the way, we have seen.
Yeah.
So be careful with how you think about it.
Yeah. All right. I hope this was interesting for listeners, but if not, at the very least, it was interesting for you and me, I think.
I definitely.
All right, sir. Happy weekend.
Happy weekend, sir.